For our COBT friends, it's Maynard, Mike, and Brett here with Max Layton. He's the global head of commodities research at Citi. He's an old friend, and he's covering the part of the world that we at Veriton don't pay enough attention to, and that is all of the commodities outside of oil and gas. Max, we're delighted to have you. Really appreciate you joining. You're joining us from London. I know you got a lot of things going on, so let me just start by saying thank you and welcome.
Thanks for having me. It's a pleasure.
Well, it's going to be fun. Mike, you've been talking about copper. We're going to get our chance to talk to Max about copper and everything else. What would you tell us as we jump in with Max?
Yeah, I mean, we'll hit a little bit on the economic side, crude side, and natural gas, and maybe some market movers this week for the equity markets. Just first off, 10 years right around 4.45%. And the funny thing is, like this week, there's really no economic stats of note. The Fed's meeting minutes are going to be presented, but really it's going to be kind of a plain week. So I think you're going to see a bit of bond churn this week. First of all, on the commodity side, WTI has kind of been stuck between $77 and $81 a barrel for weeks now. You saw, over the weekend, the president of Iran and the foreign minister of Iran died in a helicopter plane crash, and there really wasn't that much movement in crude oil today, which was pretty interesting to us. I'd say from the natural gas standpoint, natural gas has really rocketed here over the last 3, 4, 5 weeks, and it should. Yeah, you have summer weather approaching, which obviously we're going to see that's a big catalyst. But you're also seeing that lower 48 production is declining quicker than most people expected, and you're also seeing the surplus, natural gas storage surplus slowly inch lower. And so that's that. On the copper front, we've talked about this for the last week or two, and it's occurring again this week. But copper is over $5 a pound, and it's surging. There's a lot of reasons people expected, but a lot of traders, are out there saying it's really because these net non-commercial positions in future contracts is at all-time highs, and so we are seeing a bit of a squeeze in the front month contracts. But we'll talk a little bit to Max about that to get the lowdown there. I say the one thing we want to finish up with is this week, equity markets. The big deal is going to be on Wednesday. After the close Wednesday, NVIDIA is going to be reporting their Q1 results. They are the last of the big Magnificent Seven to report earnings. And so the market's going to be watching that really, really closely, has the potential to drive up broader markets. The one thing that I would point out to you guys is that year to date, NVIDIA is up 90%. The second best performing stock is NRG Energy, which is up around 60%. NVIDIA, it's basically the S&P gains this year, 25% of the S&P gains is NVIDIA stock price alone. Of the 5 out of the 7 Magnificent Seven stocks, 55% of the move in the S&P 500 year to date is because of 5 stocks. And so the bar this week on Wednesday is going to be really pretty high for NVIDIA. Investor expectations are high, so technology and broader markets are going to be moving probably on Wednesday and Thursday. So we're going to go ahead and leave it there and hand it back to you, Maynard.
Well, and I heard this from a friend this morning. I hadn't focused on it, but of the top 5 S&P stocks, aren't 3 of them power?
Yeah,
it's amazing. Well, Max, let's jump in with you. We're delighted to have you. As I say, I know you've got a ton going on, particularly in these markets. You've been at Citi for the last 7 years. We first met you at Goldman Sachs. Now you're global head of commodities at Citi. Congrats on all the success you're having. Maybe just jump in and tell us a little bit on, I'm amazed looking at your research. We appreciate you sharing it with us. You cover so many things in your commodities group. I mean, the stuff that's on the screen, from LNG to lithium to copper, it's really amazing the menu you're watching. Maybe just tell us a little bit about what you're watching, the group, what's on your mind. Just give us a lead in to you and your team and what you're thinking these days.
Yeah, thanks for the opportunity. So we've got a team of a bit over 10 people. So we've got a solid team, and we're trying to hire experts and have with us experts across most of the major markets. As you mentioned, we're covering 25 plus commodities. The joy of my current role is I just really get to go, or at least I choose to go wherever I think we can, either make clients and or save clients the most money. And naturally, that ends up being the biggest markets where people are the most exposed to, right? Like $3 trillion oil market is naturally a huge focus of ours. But it will also take us to places like lithium, for example, which is a tiny, tiny market. But it's super interesting because it's growing at 25% per annum. Prices just came down about 85%, and they have the potential off the lows in the next 6 months to double into the end of 2025, right? So, we'll go wherever, I can either catch a trend or a big turning point. But the kind of nice thing when you're covering so many commodities is, you don't have to force it, right? You can, there's enough interesting stuff where we can help clients and, help the staff at Citi to kind of take the opportunities that are available within the commodities complex.
And Max, it sounds like you're all based in London, and it looks like you guys work together, super collaboratively, like you're all talking about all of these markets, because I know there's some unique interactions between these markets. But maybe tell us a little bit about just kind of the team, how you span out and cover all this stuff, and also debate and compare and contrast your various pieces of work.
The team is spread all over the world, right? So we have an Asia team that's headed up by Anthony Ewan. His specialization is power and gas markets. And then he has kind of a pod of working with him. We have a North America team, which there's a precious metals director there, as well as an ags director there. His name's Akash. He works closely with his colleague who covers all of energy, Eric Lee, based in New York, and they've got their own team there in New York. And then I'm in London, and I've basically got a guy working with me on the metals in London, and a lady named Wenyu Yao, who's on maternity leave at the moment, who is our China specialist. And she's got a team with her on the China side, a guy named Kenny, who based in Singapore, who's looking at that side of things. We got a couple of people in India, Shreyas Matabushi and Vishwanath, who are helping us on lithium, cobalt, and all kinds of other India-focused and India-facing commodities. So, I'm privileged enough to have a big enough team to have a good go at the markets. Although, power and gas is a big one because I know of teams on the client side of ours, utilities who had teams of 30 plus analysts just for the European power hubs alone. So that one requires a lot of people.
So one question for you, Max. This is kind of a nerdy in the weeds question, but when you're a commodities analyst like you and your team are, unlike equity analysts who have to watch the earnings calls and the report on the earnings and all of that dynamic, but what are you spending your time doing most of the time? I know that's such a basic question, but I assume you listen to the earnings calls just for some hints at what's going on, but what are your kind of day-to-day activities? How are you getting your information, doing your analysis? What's the ebb and flow of your work?
I think one of the nice things about being on the sell side is we can get information from clients. These clients are across investment banking, equities, commodity clients, they're macro funds, quant funds, commodity-specific hedge funds. We can get information from the trading desk in terms of their views. One of the big areas where we share information internally is on the research side. We get the equity analyst forecasts, the economist forecasts, the currency forecasts, the rates forecasts. We're privy to a lot of information, and that sometimes means that a bit too much of the week can be spent on internal calls, keeping up to date, things like that. But I do think, we're privileged with all that information, and then, it helps us to figure out where we want to go, right? And for the most part, let's call it the big three, oil, gold, and copper. For the most part, these big three commodities, they are very exposed to the global macro environment. So certainly in my career, having, going wherever you need to go to get demand right and demand volatility right, which ends up being about the macro, is the most important part of the fundamentals. So typically when people talk about fundamentals, they're equating that with the supply side often. But to me, certainly in my career, the vast bulk of the volatility in both in price has come from volatility in demand and related volatility in spec positioning. So, for example, during COVID, it was all about, figuring out once we'd seen the Fed do the big easing and China do the big easing, it was just figuring out if the vaccines were, the probability of them working was rising or not. And, then it was all about trying to get ahead on the Russia-Ukraine situation before the eventual conflict. It was about, then it was about predicting the impact of European power on the European economy. The last couple of years, it's been all about monetary policy transmission channels and how quick they'll be and the different regional impacts. And now frankly, it's still a little bit about debt service burdens and whether or not them rising matters and is going to matter. So there's some calling turning points a month before they happen, based on, often just logic. Like it was fairly obvious, in my opinion, a month before the COVID shock hit the markets, that there was a virus going around China that had spread to Italy that was, that was spraying the streets. And then even Biden predicted Russia-Ukraine 2 weeks before it happened, right? So some of these things are about being a bit early. And then, most of my job is trying to predict the trends, get on the trend. Like I'm not trying to call every turning point, but we want to at least capture half the rallies or half the big sell-offs.
How do you think, Max, you said the trend, you said a ton in there we'd love to dig in on, but you mentioned the trend. Do you have, next quarter, next year, 5 years, like how do you tend to, when somebody says, well, what's going to happen with copper, what sort of timeframes do you usually talk about with them on that? Or how varied of timeframes can you talk with them on that?
I mean, outside of the very early part of my career, the vast bulk of the last 20 years or so is something like copper. You wouldn't really be comfortable forecasting beyond 12 months. I mean, it was very much about, if you go back the last 15 years, it was very much about global shock or regional shock, then China stimulus, then global recovery. And alongside that, you would have, commodities down, commodities up. And those shocks include Shale Revolution driving a deflationary shock, strong dollar 2014, 2015, which hit China, and then China closed the capital account, did a big easing. Anyway, that's kind of been the playbook of the bull markets. And unfortunately, the bull markets, the bear markets, these cycles out in the past 15 years, they've mostly been that playbook. This one's very different, and I say unfortunately because it means it's more complicated, right? This one is more complicated because the energy transition, that kind of core thematic, it's not a 1 year story. It's a climate change policy related, on paper, 50-year story, right? And, the weather doesn't seem like it's getting any less volatile, certainly not in the UK or in many regions globally. So I don't think the issue is going away. And it happens to be that China's really got behind this issue. So we've gone from calling like 3 to 12 month cycles to now having this, on paper, super long-term, super structural dynamic that is bullish copper and metals, but specifically copper and lithium volumes in my mind, to a lesser degree aluminium. But it's bearish for oil demand growth. It's bearish for potentially coal demand growth in China on a longer term view. Like I'm not saying we have a negative oil demand in the profile anytime soon. We're certainly not seeing that. But at these prices, oil demand growth looks very likely to slow based on China's super aggressive acceleration of the domestic energy transition for a variety of reasons that we can talk about. But so we've gone from super short-term cycle stuff to doing both. Now we have to call the cycle and the energy transition impacts. Yeah. And
So
the Fed. I mean, the Fed's the big one, right? They're obviously on the throat of the world economy. The world doesn't need 5% rates. 5% rates is not a stable equilibrium in my mind for the whole world. And we import the US rate. So that's the other big dynamic going on that we can chat about.
That's very interesting because we're on the Fed side, we're always talking about what's about to happen, what people are speculating will happen. This has been going on, I guess, really since COVID started and the Fed got so active. But what is the view of the Fed from Europe, if you will? Like, what's the specific, or at least the non-US monetary financial world? What do they think of the Fed? What are they hoping for from the Fed? You just mentioned 5% is way too high for a long-term rate. Give us some perspective on the Fed from your vantage point.
So yeah, this is one of the areas where I noticed that people had been unwilling up until about 6 months ago. Some of the early investors got involved. People were unwilling to put on cyclical recovery trades or anything exposed to cyclical, even if they were medium-term bullish, like in the case with copper on the energy transition stuff. They wouldn't put it on because they were worried about the impact of high interest rates on manufacturing and on global growth. And there's a kind of a thesis going around that the worst of the global impact of interest rates has happened, and therefore we're going to get a pickup in US and European activity over the next 6 to 12 months. And you know what? That's partly true, right? Like many of the channels probably have maxed out their impact on, for example, investment and manufacturing. There's been some likely to be aggressive destocking through the manufacturing supply chain due to high interest rates. But there was just something niggling at me that it didn't feel like the interest rate impact has fully flowed through. Right? I'm not saying that it's going to be net incrementally bearish because of those investment and manufacturing things. They can turn up. But there's just a logical part of it that just didn't sit right with me and many of the clients I speak with. And in the end, it comes down to the debt. So the average maturity of developed market debt is about 8 years. So of the 150 trillion of developed market debt, there's roughly 20 trillion a year maturing every year. We've only had 1 year of high interest rates where we've been rolling up that interest service cost on that debt. And this is the second year. So every year you're adding about $500 billion to $1 trillion to interest costs across the developed markets. Now, it really depends where that falls in terms of whether it's households or corporates or governments, and whether or not those governments have austerity measures. But to try and, put it more succinctly, the developed markets outside of the US have more austerity embedded in their fiscal frameworks, like in Europe. And they also have a more even distribution across the maturing debt across households, corporates, and government. And what that means is that the impact of high interest rates is going to happen more quickly and be deeper for places like Australia, the UK, and Europe than it is in the US. So I think, look, $23 trillion this year is maturing. In the US, it's not until the end of the year. It's corporate and mostly government debt. And so it's probably not that big a deal for the US. But for the rest of the developed markets, it's an increase of 1% to 2% of GDP debt service burden. And that's the only reason why I'm not like ridiculously bullish copper. Like we've been very bullish, but that to me is still a big worry.
You said that was such an interesting lead in. You said, some clients call and they think about putting on a bullish medium-term copper trend kind of bet, but they don't because of interest rates, or at least some people think that way. When people are going long copper, this is just a dopey former investment banker question. What is the best way to do that? Are they literally entering the futures markets, or are they bundling it with some equities, or are they're doing something else? Talk to us about how you place a copper bet, particularly medium to longer term.
Yeah, I think I mean, it will depend on how the clients are set up, and what their preferences are. I mean, your macro funds, for example, who want to put on a copper trade, I mean, they can choose between things like leveraged call options, or call options that give you leverage in the commodity market, or they could do equities if they wanted. I mean, honestly, it's horses for courses. One thing I will say is that equities are naturally longer duration assets. And what we'd observed over the last 6 to 9 months is that equities were rallying and pricing in, the pure play copper equities were pricing in, for the first time in my career, a substantial premium to the copper forward curve. So while the copper forward curve was trading at 8,500, the pure play copper equities, according to my equity colleagues and their modeling, were pricing 10,500 to 12,500. So the longer term investors, I think it's partly because equity investors, many of them are just more able. Superannuation funds, for example, have a big allocation to equities, and they can just take longer term views on this energy transition related demand and weak supply thematic. Whereas the commodity investors, for the most part, need to make money that year, right? The trade needs to work this year. And so they just, and also they just believe, partly true, partly, I think it's, partly true for some commodities, that commodities converge to a physical price, and therefore commodities just aren't as forward looking as equities. I think copper's proven that that's not the case when it comes to copper. We could talk about copper's quasi-equity-like characteristics and exactly why it can trade like an equity. But all that's happened is commodity investors, in my opinion, because they got a bit more confident that there wasn't going to be a major cyclical recession, and because of the AI story and some supply issues, they felt more comfortable putting on the trade that like it was going to happen this year instead of next year or the year later. Initially most people thought this year was going to be a big downturn, across the developed markets. And that's quickly been revised away. With that, people needed to have a trade on. So you look across the whole commodity complex. Where do you want to have a cyclical trade? Probably in the thing that you love structurally. So that's why $25 billion is come into copper. And much of which is macro, in my opinion. It's basically macro and machine has come into copper.
And Max, I don't want to pin you down on a short-term outlook for copper. I really want to kind of go at, you've been out there lately talking about a secular bull market for copper, and I would agree with that. And, something really kind of struck me when you said that, volatility tends to be either, demand-led or spec position or a combination of both. And so I guess what my question is when you think about the copper secular outlook, say the next 3, 5, 7 years, whatever the case may be, are you more convinced with the demand side basically being as good or better than expected, or are you thinking that supply is not going to be there, or some combination of both?
Thank you. I'm more convinced on the demand. I'm really convinced on the demand, and it's kind of like I'm just feel lucky that the reason why I call it the second secular bull market this century is because it's the first time you can project demand in a model out beyond 12 months with any kind of confidence since China's urbanization and industrialization. I remember my boss at the time, Jim Lennon, and he was calling for years and years of secular strong demand growth in the metals markets on the back of China's urbanization, industrialization. With the energy transition, you can actually do the same thing. And it's not so much the energy transition. It wouldn't be enough just to know that governments want to do it. I think where the confidence comes from is all about China, right? It's about President Xi saying that the excess savings or the money that is generated through the banking system is allowed to go into these sectors. The kind of numbers. It meets a lot of China's goals. Where the confidence comes from is that it enables China to offset the weakness in property through strong manufacturing and related infrastructure investment. It enables China to potentially export some soft power, certainly to export some manufactured goods, whether it's cars or whether it's services related to the build out of renewable energy globally, and solar panels and such like. It also, enables China to be a leader in tech for the first time, certainly in my career, probably ever, or maybe not ever, but certainly in the last 30 or 40 years, China is at the forefront of battery tech and renewable tech. And this is something that they can use to help get through the middle income trap, to at least help them transition. During that transition period, this can help drive growth and income growth while they try to shift to a consumer-led economy. It just ticks so many boxes for President Xi. And just say one more thing on that, which is that everything that I've seen China do within the commodity complex, whether it's infrastructure, manufacturing, or property-related demand, whenever they set a target, they usually beat that target dramatically, full stop, right? So I ran a scenario the other day where I looked at them, how much they would have to add to their solar generating capacity per annum so that they could displace the coal consumption and get to net zero by 2040. Just a ballpark, super ballpark scenario. And basically they could double their solar capacity installations from 200 gigawatts to 400 this year and hold it at 400 every year through 2040. And then they would get to net zero quicker. I mean, and this is entirely plausible scenarios that, they represent our bull case scenario in our balances, but that's what gets you so excited about anything that is demanded through the energy transition. I mean, one other thing is they're basically, China's pumping in roughly twice the capex per annum than the US was pumping into shale before the shale revolution. In other words, you can expect technological innovation in China now as the base case, because it was really that kind of, not trapped capital in the US, but it was the huge capital that was willing to go into shale that effectively, in my opinion, led to the shale revolution. And right now we're seeing exactly that. There's a battery that China's come out with last week, CATL, that is not affected by the cold or the heat. That is LFP with the same energy density as nickel batteries, similar anyway. And this thing will charge in 3 minutes in an extended range electric vehicle format and take you 1,500 kilometers in an SUV. So, their tech, if it's not there today, it'll be there in 6 months in terms of overcoming range anxiety, price, and charging anxiety. Won't come to the West for quite a while, but yeah, this is what gets me all excited about the copper story. Frankly, I think it's not. You can't really bank on it being a 10, 20-year story. It's all going to happen in the next 3 years. China's going to reach its max acceleration of investment in these areas over the next 3 years.
One of the things I thought you were going to say, the reason why you're more positive on demand was not because of China, but because this global energy transition is not just a China story, it's a global story. Whereas the last secular bull market in copper was really China building out their infrastructure and all, construction stuff of that nature, and that kind of has cooled down. Any thoughts there? Am I missing something there, or does that make you feel better that it's just not a China thing? It's a global thing.
Of course, yeah. I mean, don't get me wrong. It's great that it is global. It's just, I think it would be much slower, and I'd be much less excited in the near term about it if China wasn't innovating to overcome the obstacles, whether it be range anxiety in EVs or the heat and cold impact on LFP batteries, or whether it be about driving down the cost of solar, right? Like that's being led by China, but it will be adopted globally over time, over the next couple of years, I think. Eventually, this tech, one way or another, either through JVs like Stellantis has done with Leap Motor, where they're going to be bringing the Chinese cars, although manufactured in Europe and the US, into these countries, or trying to, or other ways that the tech will make its way out of China. That it's coming. But yeah, it's a global thing. And, Europe's getting behind it in a big way, and the carbon border adjustment mechanism will probably accelerate that further. US is, I think a lot of the energy transition theme is taking a bit of a battering at the moment outside of China, frankly, whether it's tariffs or the dropping EV sales in SUV and truck category in particular. It's taken a bit of a hit here, which is probably why I mentioned I'm more excited about the China side, because that provides the medium-term, rebound in the West.
Max, real interesting, and I know we've spent a little bit of time talking about copper here, but the trends and the topics around it are kind of very similar to a lot of what we've been talking around in my world around uranium, whether it's China, Russia, Ukraine war, any of these factors going on. How are you all thinking about uranium? Is that an area that you all are very focused in right now, especially following, the large sources of Western investment and the recent, passage and signing into law of the United States ban on Russian enriched uranium? Is this an area that you guys have been focused on much?
Yeah, it sure is, Brett. Actually, I remember when I first moved to London, my boss at the time, through a massive, I think the World Nuclear Association does a document every 2 years. He threw it at me, and I think it was like Monday night or something, and he's like, I need a presentation on uranium on Wednesday. You've got to figure out this entire market and give me a proper outlook. So it was my first, I think I still got a T-shirt saying "Uranium Man." People used to, because I caught the first uranium bull market. That was really good fun. Uranium. Look, I think that maybe if I was just say a few things on it, because I actually took a group of clients to go to Uranium One's assets in central Kazakhstan back in 2008, and I know a little bit about the market. The main thing that I think is really interesting, two main things that I would observe. First one is that unlike all the other commodities, it's the only commodity that I know of where if you buy the ETF, you're buying physical. Like you're actually getting a physical unit that's backing that. And those physical units that people have bought, they come away from inventory globally. So there has been a non-zero impact of a huge amount of physical buying by investors on the uranium price in the last couple of years. And while the bull market's going on, doesn't matter, right? But one day, the moment we start to think that maybe there's enough enrichment capacity in the world, then that's, I think, the key. Like that, for me, that's when you want to start to be really concerned about your uranium position. And until then, I think it's going to be fine. $100, $80, $90, $100 plus. I think uranium's just fine. But at the point where enrichment starts to go down, when the world feels like it's got enough of that capacity and the reactors have secured enough long-term supply, and maybe the concern about the Russia supply starts to die down, then you can have quite something of a self-fulfilling selling of physical spot from investors to who in the spot market, right? One day. Now, I don't want to call that too early. We're medium-term bullish, and there's the various structural thematics, but I think it's underappreciated how much of a direct substitute SWU, or separative work units, is for uranium, and the impact that has on the physical balance globally. So right now, shortage of, fear of shortage of SWU, big bull market in SWU, haven't seen it for 15 years. At some point, people may get comfortable, and maybe it takes 2 years for USEC, or the old USEC. It's got a new name now, but my colleague does all the uranium work for me, so I can't remember it. But the old USEC in the US to replace the enrichment capacity that it's lost from the Russian units. But at that point, I'd be running for the hills.
So Max, I was thinking about your China thesis, the way you set it up, which I won't do it justice, but basically the government, China Inc. sees a direction to go in, which is good for a lot of reasons for them economically and otherwise. Maybe I could ask you, how do you think that fits with, just every other day, the rivalry with China, the tension with China, we have to onshore to replace Chinese, exports. Like, how do you see China's role as a energy transition sort of leader and exporter? How do you kind of reconcile it with this current situation we have with them, which feels like increasingly antagonistic? How does that factor into your approach to all this?
Look, I think the thing with the China tech, whether it's renewables or EVs or batteries, is it's cheap. And it's cheap relative to traditional sources of power and traditional ICE vehicles. And that's why, China's taken market share in markets like Brazil, which don't have a natural kind of excess of power endowment. So it doesn't necessarily make a lot of sense for EVs in Brazil, but they're cheap, so they're taking market share. And I just think that is going to be it might slow down the entry of China's vehicles and tech into the US, but it's not really going to stop the flow of this of the flow of the energy transition related sectors to the rest of the world. Also, I kind of feel like the next round of tariffs, we've seen a lot of the tariffs. I've got to say that the next round of tariffs on China that potential President Trump's talking about is, he's looked at those tariffs before and decided not to do them. And the primary reason is probably because they will more directly lead to consumer price inflation. So I'm not sure he does them. So I think the bark is probably louder than the bite in the end on a lot of these trade tariffs.
And do you think this is a really unfair question? But at least maybe you can help us think about how to think about it. But the Chinese, one of the things we'll talk about here is from a national security standpoint, having a lot of electricity provided by coal that then uses electric vehicles in the cities. That sort of combination is better than having refineries that use imported oil and ICE vehicles. So we kind of frame it up as a security thing. How committed do you think the Chinese are just on their own to the transition-like thinking versus just being economic animals that are just focused on, whatever's best for China and whatever's in China's national security?
I mean, I'm kicking myself for missing the security angle. Yeah, I think it's very much to do with security as well. It's in their best interest from a energy independence perspective. So on that note, I think this is, slightly related. It's just started to come out that the government is in the early stages of trying to encourage the coal-fired power plants to upgrade or change their facilities so that they can operate as peaker capacity. So essentially that would enable much more additions of solar and wind, such that whenever they are out, you can use the coal as switch on, switch off, like what the kind of West does with gas peaker capacity. Now, I mean, this is just a sign of how committed they are to even switching off their coal production. It provides an avenue of growth, upgrading all these plants. It provides an avenue of growth for them to add, to build more solar, to add the solar. And yes, it's contractionary for coal, but it keeps their coal resource in the ground at the margin. And, they can bring it on anytime they want. So I kind of feel like, and they're also displacing their oil imports, at the margin compared to what they otherwise would be doing. So yeah, they're really moving in that direction. And every time I have a doubt about it, there's, within a couple of weeks, it tends to be a media article about how they're solving that particular problem. Like one of the big ones was, how are they going to build enough batteries? Well, they don't need to build that many batteries if they're switching on and off of coal plants, right?
One thing, just because we haven't touched on it, Mike, jump back in here, but we've talked a lot about the demand side for copper and the drivers and all of that. And we need to talk about the speculative funds. That's always everybody's favorite topic. But what about the supply side of copper and where we're getting it, the age of the mines, the outlook for more resource, just because it seems like the supply side copper story does make you wonder where all of it's coming from. Talk to us a little bit about the supply side on copper.
So this is a market that doesn't really churn out a lot of supply growth. Overall, I mean, trend supply growth is around 2% over the last 20 years. Last couple, and every year consecutively, this is a market that disappoints on supply. So every year, analysts come in, and this is literally since data that we started doing back in 2003, or Wood Mackenzie started doing in 2003. Every year at the start of the year, analysts put in their numbers for that year, knowing that they've been out by 5% on average every single year for the previous 15 years. They put in the numbers, and then they still miss by 5%. And we've done that consecutively year in, year out. So this is a market that always disappoints and ends up producing on average 2%. I think over the next 5 years, our numbers are about 1%. So it's not X supply growth, but it is, on paper, we have about a halving in supply growth. And that is, we get through some supply next year on paper, and then there's not very much after that. It looks like a bit of a gap, 26, 27. I mean, I don't think you should rely on supply to drive the bull market. I think the mine supply side of things, it's important, especially if, for example, Cobre Panama, which is almost 2% of global supply, is delayed further. We don't assume it comes back till the middle of next year, but some people think it won't be back for 2 or 3 years. But generally speaking, sub-trend mine supply growth, but nowhere near as bad as many people will tell you about how there's a cliff edge on supply. Honestly, there's been a cliff edge on supply 5 years out. My entire career has never happened. And the reason is primarily because the copper miners don't want to have declining supply. So they invest in satellites, or they find new deposits within the existing asset, or they invest in new mines, right? So they find their way out of this decline rate typically. So there won't be a cliff edge. But, sub-trend mine supply growth is tough to find copper, and that's supportive for the story, but not enough.
So maybe just while we're on this, just supply demand to the size of the current world copper market, tell us what it might look like 3, 5, 10 years out. Like what's the scope of the potential change that we're talking about here?
Yeah, so 2020, let's do last year, global total copper consumption. So the way we do it is not just refined, we also add in the old scrap that comes back and is consumed. So if you include old scrap and mine supply, the total consumption for copper is about 27 million tons in 2023. And we think, let's say by 2030, we're going to get up to around 32 million tons. So the market overall is increasing by about, let's call it fifth or so over that period, which, I mean, it's slightly above trend, around 2.5%, 3% trend. And I've got to say, I mean, that's pretty amazing for us with high conviction to be able to say that we're going to get above trend demand growth for 7 years. Like, that's actually pretty phenomenal. And that pretty much all of that is assumed to be coming from energy transition, decarb sectors. And we assume, major reductions in intensity, right? So we're not assuming that we stay at today's intensity and then we get shocked to the downside. Like, overall, these are relatively conservative numbers. And yet we're we're not putting in much cyclical demand because, we're worried about China property for a long time. And we're worried about, the developed market demographics over the next 5 to 7 years. So we didn't want the bullishness on copper to depend on cyclical, or what we call non-decarbonization, which we broadly called as cyclical demand. So it doesn't depend on it. And that's all gravy, right? So in other words, if you have any year in the next 7 years where there's a cyclical upturn, there won't be enough copper in that year, right? Or you'll have a big draw in copper inventories in that year. And that's why it's so exciting, because it's basically super levered to global up cycles, because you eat up all the mine supply with your energy transition demand, and then it's kind of going to be a cyclical commodity on steroids, really.
Max, we kind of touched on uranium. We really hit on copper. We talked a little bit about oil. We haven't really talked about natural gas at this point. And the reason why I want to talk about it is, this morning we saw the UAE ADNOC basically just get an 11.9% position in next decade's Rio Grande Phase 1, and I think a 20-year offtake on Phase 4. And so I guess my question for you is, what does the U.S. Gas market look like to you? What do you think is going to happen over the next couple of years, and what does a global market look like as well?
I mean, certainly gas and power are super exciting markets, particularly gas and LNG on the volume side. The volume growth looks phenomenal over the next 5 years. And there's various upside cases to even the bullish volume growth numbers that we're looking at, whether it's India through a regulatory shift, starting to import more gas. Certainly Europe's likely to be importing more and more gas over time. I think in terms of price, we see some convergence in pricing between Henry Hub and Europe, or Henry Hub and global prices, over the next 12 to 24 months. Beyond that, it's a bit more difficult. Obviously, there's so many different things that can impact the gas markets over the medium term, but it's kind of a bit reluctant to call it beyond 2 years, other than strong volume growth in terms of price. But next year, our kind of top gas view is Henry Hub up to $5, $5.50, versus the forwards at around, well, we've seen a big rally the last week or so probably around $3.50 to $4 for 2025. That's probably our top gas price view.
Max, so I think we, as Mike said, we talked, now we hit natural gas, we talked copper. One of the areas that we haven't touched on, and I can't help myself, but I've been watching these gold mining shows on Discovery and the learning channels for years and everything. And I've just been seeing the insanity around some of the gold prices and just the constant raise we're kind of seeing around in the commodity space there. Could you offer or give us a little bit of context around what's happening there and where we might see gold going in the next couple of years here? Is this something that's going to continue? Is this something that we shouldn't be paying as much attention to? How do you guys think about gold?
Yeah, what to say about gold? Look, I think this gold bull run is different. It's different to prior lower real rate, weak DM, strong EM gold bull markets that we've seen in my career. It's very different. This one is about like a core base of strong central bank demand, plus high levels of investment, primarily driven by Chinese retail, but also with a little bit of physical barb strength from North American and European investors who, in my opinion, are barbelling their equity exposure, which, as you mentioned at the start of the call, the equity rally has been amazing, but it's fairly narrow and it's not without risk. So, you barbell and add some gold exposure alongside that to hedge against the downside. But just to put some numbers on it, China's imports, non-monetary gold imports in the first quarter, the value of them increased by about $40 billion year on year in the first quarter. Those imports represented 2/3 of ex-China mine supply, 2/3. So China just it sucked up all its domestic supply, and it imported 2/3 of ex-China supply. Right? So this is a core tenet of why gold has been able to outperform real rates over the last 3 to 6 months. Then you ask why, right? Like, where'd the money come from? Why is it happening? How structural is it? So one thing you can do is you can compare it to the decline in the value of primary property sales in China. So primary property sales are down ballpark about $100 billion year to date, April, of which $40 billion looks like it's gone into gold. So I think you can very much tie the China's households' choice to shift their excess savings into gold, because they otherwise would have put it in property, but now they're putting it in gold, to a lesser degree equities, and probably under the mattress or in cash or something like that. So the money's not allowed out of the country. They have excess savings. It doesn't want to go into property at the moment. I don't think it's going to want to go into property for speculative purposes for the foreseeable future. In other words, I think you can bank on this gold demand in China being sticky. There's going to be elevated levels of retail imports into China. I think we think for this year and for the rest of next year. We think the same with the central bank. And these are the two things that are underpinning 22 to 2400 gold. Because, if you imagine that central banks and investors and Chinese retail investors are taking the bulk of global mine supply, then it doesn't leave much mine supply for jewelry and for the other sectors, for industrial, for the other sectors that want to consume it. So what's happening is you're trying to price out the jewelry. You're trying to reduce the industrial demand. You're trying to drive up the price to get people to scrap their jewelry, to fill this gap, to kind of fill the gap. And that, that's been a characteristic of all the gold bull markets for, there've been different investment drivers, but ultimately investment has priced out jewelry demand and priced in scrap supply. And that's been a characterization of all the bull markets. So anyway, that explains where we are today. In terms of the outlook, where we are today and a bit of the outlook on the core things, where do we get the upside? Like, we've got $3,000 gold, base case, 12 months. The upside comes from investment demand through ETF and more North American and European demand as a result of the impact of the rising debt service burden, weakening labor market, and falling real rates. That's where the next leg comes. You could also get to 3,000, not our base case, if Trump gets elected and he puts in place the China tariffs. In that world, it would be likely stagflationary. And even if gold doesn't go up a lot, it will massively outperform other asset classes because those are all the difficult tariffs. If he does them all, inflation will highly likely go up and global growth will highly likely go down. So, so that's a bit about our gold views.
This is awesome, Max. This is why it's so great to grab you. It's like going to the mall. There's like so many flavors we can talk about here. We're coming up on the hour. We really appreciate your time. You said two things in the lead in. I just wanted to circle back as we wrap up. One, you said oil, gold, and copper, the big three in terms of the commodities. And you also referenced oil, plateauing, farther out in the horizon. As you think about oil plateauing or even decreasing globally in terms of consumption, when do you think about that potentially happening? I know it's very hard. We're talking about decades, of estimates and such. But how do you think about the oil market as you think about that plateauing comment you made?
We essentially see oil demand growth underperforming GDP, and at the right price, emerging markets will pick up the oil and use it and grow more strongly than they otherwise would have. And so this is why you don't see negative oil demand growth for very, very long time on paper. But it's happening now, right? Oil's under, like for example, we've got by the end of 2025, copper to oil ratios normally about 100 and range is probably 80 to 120. We see it going to 200 copper to oil by the end of 2025. So it's going to have an impact now.
I'm sorry, and those ratios, are you talking, Max, about, are those price ratios? What type of ratios? Price ratios. Okay, final question, because you just hit a nerve. It got us excited. You commented on watching power prices in Europe and how they could be affecting industrial activity. this has been a big theme with us, watching power prices around the world and how it was affecting businesses. Can you comment on that and power prices and what you think it means for industrial activity in Europe or anywhere else?
I mean, I think in hindsight, we were really surprised how limited the impact was of what many analysts did, or at least we did, is we looked at the spot pricing in the markets, assumed a pass-through, and the impact on the economy was supposed to be way larger than it was. In other words, I think there are many fixed price contracts that meant that the spot price increases we saw in electricity and gas in 2022 didn't pass through and will never pass through to customers. So I think that was a lesson learned in the sense that unfortunately you couldn't know because these contracts aren't public. In any case, power prices come way back down. Industry does appear to be picking up a little bit off the lows, but it's hard to see Europe becoming super competitive as a manufacturing hub until it's more aggressively rolled out the carbon border adjustment mechanism and it's more aggressively rolled out its renewable capacity, because it has the potential to be, outside of China, one of the green manufacturing hubs of the world if they really keep pushing. And that's pretty exciting for Europe. But look, I think we're years away from that.
Fascinating. Well, Max, we really appreciate it. It's great to reconnect with you after all these years. Please come see us in Houston and let us know how we can help you and your business. But we really enjoyed visiting with you.
Thanks, man. Thanks, Brett.
Thanks, Max. Thanks, everybody.